Hello, I'm John Siegel, a wealth manager here at Willis Johnson and Associates. We're a comprehensive financial planning firm with expertise in BP benefit planning. Let's talk about the BP pension, the Retirement Accumulation Plan, or RAP. One of the biggest myths that seems to pervade people's understanding is that they have to start taking a regular pension payout immediately after retirement. The problem with this myth is that it undermines all the planning and maximization strategies that are possible with the BP wrap pension. You can take the distribution as a regular payout or what is called an annuity immediately. You can take it as a lump sum. You can take it as a partial lump sum or a smaller annuity. You can roll the lump sum over into your IRA. You can take it as an annuity or lump sum a couple years after retirement, say at age 62 or age 65, or sometime later until you're age 73 or possibly 75, depending on your age. The key here is understanding how the interest rate environment can play into your election. While working at BP, your pension's cash balance is credited with a percentage of your pay based on your years of service and age. Additionally, this cash balance is credited with an interest credit, the 30-year Treasury rate, or a minimum of 5%, unless you were hired or rehired after January 1st of 2016, in which case your interest credit would be currently at the 30-year Treasury rate, or a minimum of 2%. After you retire, that interest credit continues to be credited to your pension until you commence your benefit distribution. Now, if you became a participant on or after January 1st of 2014, the balance of your account is your pension balance, your pension cash balance. And you can take that lump as a lump sum or as an annuity. However, if you were a participant in the wrap pension prior to 2014, the benefit calculation is a little bit different. Now, with this pension calculation, here's an important thing to understand. The lump sum amount can increase when interest rates are lower and decrease when interest rates climb into a more moderate or high range. The BP pension uses the corporate bond yield curves. These are known as segment rates. These segment rates have been at historically low levels, at least through early 2022. But then they have risen quickly under the forces of inflation. One of the key drivers to these rates is the federal funds rate set by the Federal Reserve. As the Federal Reserve has been focused on reining in some of the highest inflation we have seen in 40 years, the lending rate has risen 20-fold since the beginning of 2022. The lending rate is now at a level that we have not seen since prior to the Great Recession. And this is what we have seen with the segment rates. You can see that the short term, the first segment rate, has increased 7-fold in just 2 years, and the moderate term second segment rate has almost doubled in that same time. These short and moderate term rates have the largest effect on the determination of the BP lump sum pension. So how does this actually work? As a basic example, consider the following scenario. You have a $1 million cash balance in your pension. You have a life expectancy of 22.9 years based on the mortality tables. The lump sum calculation is generated on a benefit beginning at age 65. That renders an estimated annuity of around $6,200 per month. Now, comparing two retirement scenarios, retiring and taking a benefit when rates are historically low, similar to early 2022, and retiring and taking a benefit when rates are more normalized, similar to this year or even in years past. The applicable rates for these scenarios, that is, the segment rates posted 4 months prior to the elected distribution date, are, for this particular example, 0.7, 2.55, and 3.06 for the low rates, similar to what we saw in the midst of the pandemic, and 3.71, 5.05, and 5.42% for the more moderate rates, similar to what we are seeing now or what we've seen in years past. The calculated lump sum based on these rates is as follows: $1.262 million for the low rates. So an augmentation of the $1 million cash balance of $262,000, and $993 for the moderate rates. But you never get less than your cash balance. And what is your cash balance? $1 million. So what do you get? $1 million. So what do we see here? We see a breaking point where the segment rates may be irrelevant, depending on what the prevailing rates are when you choose to take the pension benefit. If interest rates are in a more moderate or high range, your cash balance will not be augmented. This may provide a planning breakpoint for you. If you have the augmented lump sum calculation because interest rates are low, you would likely want to elect the lump sum immediately. If you do not have the augmented lump sum, you may wish to defer your election until a later date. Now, once again, you could take the pension as a lump sum and roll it into your IRA, or you can take it as an annuity based on your life expectancy. There's one thing to be clear on. If you take the annuity, you and your spouse are the only beneficiaries of these assets. Once you both pass away, there is no benefit to pass on. If you take the lump sum, you can pass that amount on as a personal asset to your children, your grandchildren, your favorite charity, or whomever. So what would be an ideal strategy now if you're looking to exercise an election for the lump sum benefit? Wait. The 2-year forecast by the Federal Reserve holds that inflation will drop and the interest rates could drop as much as 2% by 2025. If this happens, will we see the kind of augmentation in the lump sum as shown in our example? Not as much. However, there is some potential for significant augmentation if rates do drop. And there's not a cost to waiting. If you are eligible for the segment rate calculation, you are also eligible for the minimum 5% interest crediting to your cash balance. So, when would be the best time to make the election then? Well, that takes some analysis, and that's the kind of analysis we provide to our clients, particular to their needs. The wrap pension is a terrific benefit. Very few U.S. employees have pensions anymore. Yet there are a lot of planning questions that arise. Answering all of these questions can be daunting, and that is a great reason to work with a financial planner to develop a plan custom to your needs, providing the clarity and confidence in your decisions. We are experts on BP benefits. We provide a lot of insight on BP benefits, and we help BP professionals and executives plan around their employee savings plan 401k, their wrap pension, their share value plan stock, their HSAs, and other benefits. Connect with us online and stay up to date with our insights. If you want to learn more about the wrap pension and other benefits, click on the link in the description to watch a free webinar on how to maximize your BP benefits. And reach out to us for a discussion about your needs. We provide a complimentary analysis showing you various possibilities and how we can help you do the best with your BP benefits.